Stop whatever you're doing and pay close attention, because what just happened in Congress could quietly reshape the financial future of millions of Americans, possibly including you. A decision has just been approved that's already sending shockwaves through Wall Street, a sweeping new wealth tax. This is not just another headline or political debate. This is a fundamental shift in how wealth is taxed, how assets are evaluated, and how money must be managed from this point forward. If you invest, own a business, hold real estate, or even dream of building real wealth one day, this matters to you. The rules have changed, and failing to understand them could cost you far more than you expect. Let's clear something up immediately. This is not only about billionaires. The media will focus on the ultra-rich, names like Jeff Bezos or Elon Musk, but the reality is much broader. The structure of this new wealth tax reaches well beyond the top 0.1%. It directly impacts upper-middle-class families, successful entrepreneurs, long-term investors, and people who have simply worked hard, saved consistently, and built assets over time. If you own a home in a high-demand market, hold a substantial retirement portfolio, or run a profitable business, you may already be closer to the line than you realize. And here's the most unsettling part. The rules are complex, enforcement is aggressive, and the penalties for mistakes are severe. So what exactly is a wealth tax? Unlike income tax, which applies only to what you earn in a given year, a wealth tax targets what you already own. Your total net worth becomes the tax base. That includes stocks, real estate, business equity, investment accounts, art and collectibles, and even digital assets like cryptocurrency and NFTs. Each year, you'll be required to calculate the total value of all your assets, subtract your liabilities, and pay a percentage of what remains to the government. This isn't a one-time assessment. It happens every single year, regardless of whether your assets produced income, whether markets are down, or whether your wealth is even liquid. At first glance, the tax rate may not sound extreme, 1%, maybe 2%, but run the numbers. On a net worth of $5 million, that's $50,000 to $100,000 every year, on top of income taxes, property taxes, capital gains taxes, and everything else you already pay. Over a decade, that becomes a massive transfer of wealth. History shows us something else as well. Once a wealth tax exists, rates tend to rise, thresholds tend to fall, and more people get pulled in. What begins as a tax on the super rich often evolves into a tax on anyone with a meaningful nest egg. Now add enforcement to the equation. The IRS and state tax authorities are preparing for the most aggressive oversight expansion in decades. New agents are being hired, advanced tracking technology is being deployed. Banks, brokerages, and even foreign governments are coordinating data sharing. The era of hidden assets is rapidly disappearing. Underreporting or failing to comply isn't just risky, it's dangerous. Penalties can include crippling fines, asset seizures, and in extreme cases, criminal charges. The message from regulators is unmistakable: comply fully or face the consequences. You might think, this doesn't apply to me, I'm not wealthy. But take a closer look. The threshold is set at $2 million in net assets. In today's economy, that's not an unreachable number. A home in a major city, a retirement account built over decades, and a small business or investment portfolio can push you surprisingly close. And thresholds can change. What's $2 million today could be $1 million tomorrow. Governments are under pressure to raise revenue. Once the system is in place, expanding its reach is as easy as adjusting a number in the law. So what should you do? The first step is awareness. You need a clear, honest picture of your net worth. That means accounting for everything: real estate, investments, business interests, retirement accounts, vehicles, collectibles, and digital assets like cryptocurrency or NFTs. Subtract your liabilities and see where you truly stand. If you're anywhere near the threshold, it's time to think strategically, not emotionally, and not illegally. The good news? There are legal, ethical, and time-tested ways to reduce exposure and protect what you've built. The world's top financial advisors and tax attorneys don't panic, they plan. In the next part of this series, we'll break down the most effective strategies available today, including trusts, family-limited partnerships, charitable structures, intelligent asset allocation, and compliant offshore planning. These tools aren't about hiding wealth. They're about structuring it correctly, staying within the law, and preserving your financial future. When done properly, they allow you to protect assets, minimize risk, and sleep at night knowing you're prepared, not exposed. The rules have changed. The only real risk now is ignoring them. Before we dive into solutions, we need to take a step back and understand why this is happening in the first place. The truth is, the US government is under immense financial pressure. Record budget deficits, exploding national debt, and growing demands for social programs have created a desperate need for revenue. And politically, there is no easier target than wealth. For years, polls have consistently shown strong public support for higher taxes on the wealthy. Politicians have seized on this sentiment, framing it as fairness, asking those who have more to pay their share. But history shows us something important. Wealth taxes rarely stay confined to the ultra-rich. Over time, the thresholds fall, definitions expand, and more people get caught in the net as governments hunt for additional revenue. What starts at the top slowly creeps downward. There's also a broader narrative driving this push: economic inequality. The gap between the richest Americans and everyone else has never been wider. To many, a wealth tax feels like justice, a way to rebalance the system. But the reality is far more complicated. Wealth taxes are extremely difficult to enforce, often drive capital and talent overseas, and frequently end up harming investment, job creation, and long-term economic growth. In many countries that tried them, wealth taxes were eventually repealed after doing more harm than good. The debate is intense, the politics are charged, and the consequences are enormous. Whether you support the wealth tax or strongly oppose it, one thing is undeniable: you can't afford to ignore it. The rules have changed, the risks are real, and waiting could be costly. Now that you understand what's at stake, it's time to talk about practical, real-world steps you can take to protect yourself in this new era of aggressive taxation. The first and most critical move is gaining absolute clarity on your net worth. This goes far beyond checking your bank balance or scrolling through your investment app. You need a complete inventory of everything you own. That includes real estate, retirement accounts, brokerage portfolios, business interests, vehicles, collectibles, and digital assets like cryptocurrency or NFTs. Then you subtract everything you owe: mortgages, loans, lines of credit, and other liabilities. What's left is your true number. If that number is anywhere near the $2 million threshold, planning needs to start now, not later. Once you know where you stand, organization becomes essential. Tax authorities are preparing to demand detailed, accurate, and well-documented reporting. That means property deeds, account statements, formal business valuations, appraisals for valuable items, and clear records of outstanding debt. This is not the time to be disorganized. If you're not already working with a qualified accountant, tax professional, or financial advisor, now is the time.
The cost of expert help is trivial compared to the potential penalties for errors or omissions. Next comes strategic planning, and yes, this part must be done legally and carefully. One of the most powerful tools available is the use of trusts. Trusts are not just for billionaires. When structured correctly, they are IRS-approved tools that can separate assets from your personal net worth. For example, an irrevocable trust can hold investments, real estate, or business interests. Once transferred properly, those assets may no longer count toward your taxable estate. But this is not something to cut corners on. The IRS closely scrutinizes trusts that appear to exist only on paper. The trust must have real substance, an independent trustee, clear terms, and legitimate purpose. This is where an experienced estate attorney is indispensable. Another powerful strategy is the Family Limited Partnership, or FLP. This structure allows you to place assets such as a family business or investment portfolio into a partnership and then gift limited partnership interests to family members. This can significantly reduce the taxable value of your estate while still allowing you to retain control. FLPs are complex and highly scrutinized, but when done properly, they can preserve wealth across generations. Charitable planning is another intelligent option. If giving is already important to you, tools like donor-advised funds or charitable remainder trusts can be incredibly effective. These strategies allow you to make contributions, receive immediate tax benefits, reduce your taxable net worth, and still support causes you care about over time. In some cases, these structures can even provide ongoing income during your lifetime. Business owners should pay special attention to structure. If you own a company outright, its full value may be counted toward your net worth. By restructuring as an LLC, S-corp, or other entity and using tools like buy-sell agreements or minority interest discounts, it may be possible to legally reduce the assessed value. This area is complex and requires professional guidance, but ignoring it could be extremely costly. Finally, don't overlook the strategic use of debt. While debt is often viewed negatively, in certain cases it can reduce net worth for tax purposes when used responsibly and within the law. This is not about reckless borrowing, it's about intelligent planning. The key takeaway is simple. Panic is expensive, but preparation is powerful. The wealth tax is real, the enforcement will be aggressive, and the cost of inaction could be devastating. The time to protect your assets, your legacy, and your peace of mind is not someday, it's now. For example, carrying a mortgage on your primary residence or an investment property can reduce the amount of equity subject to the wealth tax. The same concept applies to business loans or lines of credit, which can offset the value of business assets. This doesn't mean taking on reckless or unnecessary debt simply to lower taxes, but when used carefully, leverage can be a legitimate component of a broader asset protection strategy. Offshore planning is another topic that attracts both interest and intense scrutiny. The era of hiding money in secret foreign accounts is long gone, but legal international diversification still exists. Certain foreign trusts, insurance structures, or overseas real estate investments can offer asset protection and potential tax advantages. However, the reporting requirements are extremely strict. The IRS now shares information with dozens of foreign governments, and failure to properly disclose overseas holdings can result in devastating penalties. If offshore strategies are on the table, working with a true specialist is essential. This is not an area for guesswork. Retirement accounts also deserve special attention. Under the new law, most qualified retirement plans, such as 401ks and IRAs, are currently shielded from the wealth tax. That makes them one of the most powerful tools available. Still, it's critical to review beneficiary designations, contribution strategies, and long-term planning options. In some cases, Roth conversions may make sense, depending on future tax expectations. Retirement rules are complex and subject to change, so staying informed and adaptable is key. State taxes add another layer of complexity. Some states are actively considering their own wealth taxes, often with lower thresholds and different rules. If you live in a high-tax state, relocating to a more tax-friendly jurisdiction may be worth exploring. But caution is critical. States are aggressively challenging so-called tax refugees. To pass scrutiny, you must demonstrate a genuine relocation, not just a new mailing address or driver's license. Now let's bring these strategies to life with real-world scenarios. Imagine the Patel family, owners of a successful chain of neighborhood grocery stores in a fast-growing city. For years, they reinvested profits, acquired real estate, and steadily built wealth. When the wealth tax passed, they were stunned to realize their combined net worth, business equity, properties, and retirement assets exceeded the $2 million threshold. Panic set in. Would they have to sell stores or lay off employees? Instead of reacting emotionally, they sought professional guidance. Together with advisors, they restructured their business into a family-limited partnership, transferred certain real estate holdings into an irrevocable trust, and created a donor-advised fund for charitable giving. The result was dramatic. Their taxable net worth dropped below the threshold, while they retained control of their business and preserved their legacy. Now consider Lisa, a tech entrepreneur who sold her startup and reinvested heavily in stocks and cryptocurrency. She thought she was financially secure until the wealth tax turned her volatile portfolio into a planning nightmare. Annual valuations fluctuated wildly, exposing her to unpredictable tax bills. Lisa responded with diversification. She shifted assets into tax-advantaged retirement vehicles, donated appreciated stock to charity, invested in opportunity zones offering temporary tax deferral, and worked closely with a CPA to document every valuation and transaction. Her experience underscores a critical lesson: flexibility and meticulous documentation can make or break your strategy. Then there's Mark and Susan, a retired couple living in a home they purchased decades ago. Once modest, their home is now worth over $1.5 million due to a booming real estate market. Add retirement savings and a small rental property, and suddenly they were subject to the wealth tax, despite living on a fixed income. For them, the solution centered on smart debt and estate planning.
By taking a modest mortgage on their primary residence, they reduced taxable equity. They also established a living trust to manage assets and streamline inheritance for their children. With careful planning, they avoided being forced to sell their home or radically alter their lifestyle. These stories reveal a common theme: proactive planning, expert guidance, and adaptability. The wealth tax doesn't just affect billionaires. It often hits families, business owners, and retirees who never expected to be targets. Those who suffer the most are the ones caught off guard. Those who succeed are the ones who act early, keep precise records, and use every legal strategy available. But it's just as important to understand what not to do. One of the most dangerous mistakes is trying to hide assets or intentionally undervalue them. With expanded reporting requirements and enhanced data sharing, these tactics are more likely than ever to trigger audits, penalties, and long-term legal trouble. Another common error is delaying action, waiting until enforcement begins or deadlines loom. By then, many of the best options may no longer be available.
The new wealth tax marks a turning point. The environment is more aggressive, more complex, and far less forgiving. But with the right knowledge, planning, and professional support, it's still possible to protect what you've built. The rules have changed, but preparation, not panic, is what determines who thrives in this new reality. The IRS is pouring enormous resources into technology, artificial intelligence, and data sharing, and the penalties for non-compliance are more severe than ever. This is not the environment to experiment with shortcuts or questionable schemes. What may have worked decades ago can now trigger audits, penalties, or far worse consequences. One of the biggest mistakes people make is waiting too long to act. The most powerful strategies, trusts, partnerships, charitable structures, and entity planning, are far more effective when they're implemented early. Once you're already on the IRS's radar or facing an assessment, your options narrow quickly. Another common trap is analysis paralysis. The rules are complex, the headlines are alarming, and it's easy to feel overwhelmed. But doing nothing is the worst decision of all. You don't need a perfect plan on day one. Start with a simple net worth calculation, get professional guidance, and take steady, deliberate steps forward. Even small actions like maximizing retirement contributions or updating an outdated estate plan can significantly reduce long-term exposure. Many people also ask whether it's worth moving to another state or even another country to avoid the wealth tax. For some individuals, the answer may be yes, especially if a move already makes sense for lifestyle, business, or family reasons. States like Florida and Texas have no state income or wealth tax, and certain countries offer favorable treatment for new residents. But moving solely for tax reasons can easily backfire. States are aggressively challenging so-called paper moves, and the IRS has strict rules for expatriation. If you're considering a major relocation, legal and tax advice is essential before making any decisions. There's also an emotional side to this that can't be ignored. For many people, paying a tax on assets they've already worked for, often with after-tax dollars, feels fundamentally unfair. Frustration, anger, and anxiety are natural reactions. But focusing on politics won't protect your future. Focusing on what you can control, your planning, your records, your structure, will. The rules are what they are, and your responsibility is to navigate them intelligently for the sake of your family and your legacy. Looking ahead, it's clear that the wealth tax is not a one-time event. It marks the beginning of a new era in American financial policy. Tax laws are constantly evolving. Rates can increase, thresholds can fall, and additional asset classes can be pulled into the system. Even if you're comfortably below today's $2 million threshold, there is no guarantee you'll remain outside the net tomorrow. Ongoing budget pressure and shifting political priorities mean changes can come quickly. That's why the most successful families and investors treat tax planning as an ongoing process, not a one-and-done task. Staying alert matters. Lawmakers are already discussing whether to expand the wealth tax to cover additional assets, such as retirement accounts, certain insurance cash values, or trust structures. There is also increasing talk of exit taxes aimed at those who attempt to move assets or residency offshore. If you have international exposure or are thinking about it, future changes could dramatically alter your plans.
Enforcement is another area to watch closely. The IRS is ramping up audits, particularly for business owners and high net worth individuals. Advanced analytics are being used to flag inconsistencies, undervaluations, and unusual transfers. If you receive a notice or audit letter, the worst response is to ignore it. Stay calm, respond promptly, and involve experienced professionals. The cost of expert representation is minor compared to the risks of penalties or asset seizures. State-level developments also deserve attention. Some states are considering their own wealth taxes with entirely different thresholds and rules. That raises the possibility of double taxation, one bill from the federal government and another from your state. At the same time, other states may position themselves as tax-friendly alternatives. If relocation is on your radar, be sure to evaluate not just taxes, but estate planning rules, residency requirements, and quality of life considerations. To stay ahead, start with a clear action checklist. Calculate your net worth accurately and comprehensively. Organize documentation for ownership, valuations, debts, gifts, and transfers. Consult qualified professionals who understand the new landscape and can help you design a tailored strategy. Review and update your estate plan, including trusts, wills, and beneficiary designations. Explore asset protection strategies, such as trusts, family-limited partnerships, charitable vehicles, and responsible use of debt. Maximize contributions to tax-advantaged accounts that are currently exempt. Stay informed through credible financial sources and remain flexible as rules evolve. Above all, act early. The best strategies are proactive, not reactive. Waiting until enforcement begins is often too late. As we close, it's important to step back and see the bigger picture. This moment is a serious test, not just of tax strategy, but of long-term financial discipline. The rules may change, but the fundamentals remain. Knowledge, preparation, and decisive action are still your strongest defense. Don't allow fear or frustration to freeze you in place. Use this moment as motivation to get organized, seek expert help, and take control of your financial future. The story of the wealth tax is only beginning. Those who stay informed, prepared, and adaptable will write the next chapter on their own terms.